Very warm welcome to everybody, to our panelists and our audience. We're going to talk about an enormous subject today. We'll try and pack in a bit of insight and views as rapidly as we can. As I'm sure you're all aware, ESG and the movement of capital associated with it has been seen incredible change in recent years. And even in 2020, there was a 50% increase on ESG managed assets up to the enormous global sum of $1.7 trillion. And I've gathered here some experts to provide their own insights. You will have read on the invitation who they are, but very briefly, I can introduce Lisa Beauvilain from Impax Asset Management. And Lisa is in charge of both sustainable and ESG investing. And Impax, as you're probably aware, is one of the world's leaders in sustainable investment, and another source of evidence as to the power of this trend. 5 years ago, they were running about £4 billion. Now it's somewhere around £27 billion. We're also joined from the corporate sector by Ben Stocks, who is the CEO of the LSE mainboard listed Porvair group, who are global experts in filtration. Nice to see you, Ben. We also have BrijeshMalkan, who has a long career in business development and analytics, and set up his own company a few years ago called Acquired Knowledge, which in turn owns an ESG metrics business called Rebalance. And last but not least, we're joined by Tim Ward, who runs the Quoted Companies Alliance, who champion SME causes and have done for many years. And their work in ESG has also been quite deep lately, as I'm sure we'll hear in a minute. So without much ado, you don't listen to me. We've talked about the pace of change, and I don't in any way want to represent Lisa as a veteran investor, but having been at Impax for over 10 years, perhaps Lisa, you can say a little bit more about how the engagement between investors, who are key stakeholders, has changed with the corporate community, and presumably that point of contact is usually with boards.
Absolutely, it has, as you say, it has evolved a lot. I would say our intent with the engagement has not changed. It remains one of viewing ourselves as long-term shareholders and partners with our companies, and perhaps also sort of critical friends in trying to bring our insights of managing sustainability most effectively, as sort of a sounding board. But the world of engagement has indeed evolved a lot. First of all, I think it's very fair to say that the expectation from our investors, asset owners, and others has really changed, and there's a lot of focus on outcomes from engagements, and lots of expectations of reporting very regularly, quarterly typically, on outcomes, and what's actually changed through these engagements. Previously, it was more about providing statistics. How many meetings did we have that were related to sort of ESG engagement. Now it is about outcomes, and not just outcomes, and what is changing, but also as much as possible say, what did Impax actually do to improve or change some of the sustainability processes or governance structures, etc. So that's an important part and important aspect of looking at outcomes, but it can be also quite hard to measure. But this outcomes issue is also what the regulator is asking for. So for example, the Financial Reporting Council with its UK Stewardship Code, it is very, very focused on the outcomes of stewardship. So it's definitely getting more formal. I would also say that the topics discussed have also evolved. Previously, probably quite focused on governance and issues relating to disclosures, etc. It's becoming more strategic now. It is about long-term issues, climate change, carbon risk management as part of the company strategy, and also the governance, for example, of climate. Who is responsible within the companies for these big systemic risks to the marketplace? But also more immediate issues. For example, last year, lots of engagements around COVID-19. How are companies keeping their staff safe, of course, but also what does support look like for staff, for staff that have perhaps been furloughed for some time, and what happens then with, for example, management compensation in these circumstances. Also an interesting question around, for instance, are some board directors a little bit too overboarded, so to say, especially in a crisis situation where many more meetings come in. Also, lots more collaborative engagements, I would say, whether it's with other shareholders or organizations that take a sort of a coordinating role. And the topics vary, could be around climate. The biggest collaborative engagement out there is the CA 100 plus, which is around the biggest emitters in the world, gathering hundreds of investors together. But it could be around human capital and, for example, sustainable proteins in food companies' offerings, etc. Collaborative engagements are definitely well viewed by our investors. It's sort of the investment community to some extent coming together. Finally, the sort of company responses and how they have evolved, that's definitely changed a lot over the years. I would say, especially in the US and US companies, it could sometimes almost be hostile when we spoke about, what companies were planning to do to improve their sustainability risk management, to now really understanding it, accepting it, and even seeking input. In UK companies, we have also noticed a new trend with, especially when we enter a new holding or new position in a company, and we explain how we view sustainability and our approach to sustainable investing. There are quite a few UK companies that have actually really at the outset asked us if we would like to sort of give our inputs and views about their sustainability approach and reporting, etc. So very, very very exciting and very positive development there.
Well, that sounds encouraging, and looking in the mirror, probably a good chance for you to try and remember where you were 10 years ago, Ben. And I must say, having heard Porvair report on their results within the last month, I was very impressed at the level of detail that the group went into, and specifying what targets it thought appropriate to take on, and indeed to judge executive management by. So can you talk us a little bit about the evolution of Porvair's interest in compliance there?
Yeah, so we did our first CSR report in 2011, and it has evolved steadily since then. I would say back then we were probably more at the box ticking end of the spectrum. 2021, we published a full ESG report at the same time as the prelim numbers, separate to and at the same time as, in order to make the point that the things that we were doing in this area we considered to be perhaps not equally as important as the numbers, but very close in terms of the strategic rationale. And I think that's the heart of it. We spent 2020, we run 14 or 15 factories around the world, and we spent the quieter months of the pandemic encouraging our management teams to think about what they could do in 2020 to make sure that the business was significantly stronger when the pandemic finished. And we spent the same period of time doing the same thing from a strategic point of view for the group. And very briefly, we moved from the previous strategic focus was on shareholder value, and we've changed that to stakeholder benefit. Now, we don't really like the term stakeholders for all sorts of reasons, but it's a useful catch-all. Not all stakeholders are equal in our view. Not all stakeholder interests are equally weighted at different points of the cycle and so on. But the two stakeholders that we particularly focused on, given that every business is interested in their customers and their suppliers and so on, were certainly shareholders. for which we think, for us anyway, the ideal measure of success is consistent earnings growth, emphasis on the consistency there. And in our staff, we feel are the other significant shareholder, why we all come to work, why other people, why our colleagues come to work, how they feel about doing that. And so we spent really a lot more time on that side of the ESG balance. And we came up with really 3 targets there, certainly an employee engagement target, accidents and safety, of course, and then for us, senior staff gender balance, which in the worlds in which we inhabit is something that we need to work on quite actively. And so the metrics come out of the strategic review, and we've set these targets for ourselves. They do flow through to management incentives to a greater or lesser degree, depending on the level of the management. But I would say that it's only a start. That we've set a sort of 3 or 4 year horizon, and we'll see where we get to in 2025, and then we'll review. And I would say that's particularly the case on the E of ESG. We've set a carbon intensity target improvement, scope 1 and 2, which is really the best we can do at this stage for the sort of business that we're in. Some of our investors, we've been with Impax since 2005, I think, would like an absolute carbon target. It's not appropriate for us at the moment, but we can see that's the way it goes. And I'll say one other thing. The other critical aspect, which I must say our investors led us to, was to consider how a move towards net zero is going to affect the various activities that we do in the various markets that we serve. And that's the second and important part of our ESG report. It's all very well to say, well, this is what we're going to achieve, but there is a commercial aspect to this, which is how is the world going to change and how are we going to react to that? In our case, there are some more opportunities. On the whole, what Porvair does is good for the environment. We control emissions, we keep water clean and so on. But we've also got some challenges, and some of what we do will change and we'll need to adapt to that. So those things are sort of really fundamental now to who we are and what we do, and therefore we published the full report along with the numbers. So I think does that answer your question, Eddie?
It does. Could I just ask how much that strategic review you were able to undertake with internal resource? Obviously, all companies are different sizes, different activities. You deal in quite a regulated environment. Was that a help in you building up or having the data there to draw your assumptions from, or did you get external help?
We didn't get external help. I can see why people might, specifically if they are starting sort of further back with measurement and assessment and collecting of data. That's a major undertaking from a standing start. So I can see why people would. We didn't need to do that. Where we did seek guidance was actually from our shareholders, certainly Impax. I'm not just saying that because Lisa's on the call. Lion Trust are very strong and good in this area. Standard Life, Ecclesiasticals. Look, there are a number of very good people in this area, and we asked them all, what they would recommend, and we sort of blended what we were told, and then we have the resource to do it ourselves.
Okay, well, I'm sure Bridge will have some insights in a minute, but Tim, I mentioned excellent work done by the QCA in collaboration with Henley Business School and Downing to produce a report on ESG for SMEs, and it was titled Adoption and Practice, I think. So can you say a little bit more about what you discerned from that report, the state of readiness for smaller businesses, and is it, in your opinion, fair to expect smaller businesses to adopt the same depth of principle and execution as larger businesses?
I mean, thank you very much, Andy. It's interesting when you say, is it fair? I don't think fairness comes into it. Is, you know, do they, will they, should they, and are they called upon to do so? And I think, you know, I'll describe the research and perhaps people can draw their own conclusions. Henley, we're biased, but Henley did a really good piece of work for us, and they carried out 30 in-depth interviews, surveyed 100 companies and 50 investors, and it was all about really creating a gap analysis and seeing what momentum was there. I think one of the interesting things was when we were trying to get 30 in-depth interviews with companies, there were quite a few directors who said, well, there's no point interviewing me because we aren't doing anything on it yet, so I've got nothing to say. And one of the points we wanted to make for that and the survey was that you are exactly the sort of people that Henley should be talking to find out, you know, how you're going to go about these things and how your thinking is developing. So, I mean, just to give you some highlights of the survey, people saw ESG as being a familiar concept, but it was narrowly defined and poorly applied. In terms of the most customized pillar of the three, it was the E. G is definitely the most entrenched, and we can put up our hands to say that the QCA code for AIM companies helps that. And the S seems to be primarily aimed at diversity and gender pay gap. Now, this survey was done sort of at the start of the pandemic, and I think we would see a different result, obviously, now. But the call was really that investors want more evidence. They want to really see what's happening. And they also want to know who's accountable. And there's very much a call on the CEO to stick their hand up, but also for there to be overarching board responsibility. We asked both investors and companies how knowledgeable they were about ESG. And if you asked investors who were either moderately or very knowledgeable, that was 100% of investors. But only 23% of companies said they were very knowledgeable. And there were nearly 10% who said that they were not at all knowledgeable about ESG. And I think that, you know, that sort of takes us on to what are the drivers, what do people see as the drivers of ESG? And quite obviously, I think regulation and government are high on the list. Investors are high on the list. 70% would say that investors are on their list because they're beginning to see that it's not just the investors who want an answer, it's the investors in the fund managers, it's the clients of the fund managers absolutely demanding this. And I think that's been a pretty big wake-up call for companies realizing this. But I think the other telling thing is if you add up all the commercial bits of responses that came through, 70% of companies said that effectively what this adds up to is the ability to get a competitive advantage and to really think about the future and how one relates to the future. So, and there's lots more to talk about the research, but I think that really sort of gives an introduction to it. It was a very detailed research, but you know, really what investors want is for ESG to be defined more broadly. But the challenge for the companies is what and how do you quantify something, and what and how do you then disclose it? And I think, you know, Ben's description of how he's gone through the process is obviously a very good one. The other thing which always amuses me, the investors saying, well, we're seeing much too much short-termism in companies and we want them to adopt a long-term approach. And I think the bit in brackets, which is never said, and you know, we also want great quarterly performance as well. So there's always that tension that comes through. But you know, investors are influenced by ESG and they are taking it into account in their investment decisions. So I think all of that is, you know, our research, our report is aimed at increasing awareness. And in 2 or 3 weeks' time, we will be launching a practical guide to ESG for those who are not like Porvair, but are really starting out on the process and giving them some very practical, very basic recommendations as to, you know, get started, start doing things and start describing where you're going, where you're headed.
Yeah, good to hear that. And Bridge, you've been sitting there very, very patiently, but I don't want to set you a trap, but how do you go about measuring good governance? I'm sure you have an answer for us on that one.
And thanks, Andy, and good morning to everyone. I think I'd echo a lot of what I've already heard. We have seen broader stakeholder engagement over the past couple of years, and that sort of plays out in a couple of areas. If we look firstly at the metrics we capture, probably about 3 years ago, 80% of the metrics we were capturing were environmental in focus. And that's certainly shifted, certainly during the pandemic it's shifted, but it's certainly shifted across to a broader section of metrics across the S and the G as well. And in terms of where we sort of see good governance, I have a lot of sympathy for companies. If you look at the average ESG report, it has about 150 KPIs in there, and that's a lot of work. And there's almost this Brownian motion and compulsion to try and capture as many data points as you can as a company to try and show that you are ESG compliant. And what we feel that's certainly a mistake. Our view is that a company should focus on its core strategy, understand where it aligns to core themes. And we see themes as the connecting tissue between corporate strategy and investor focus. So really understanding what are the key ESG themes that you tap into. Is it circular economy? Is it employee satisfaction? Where are the areas that you actually focus on? And then from there, looking at understanding the standards. So there's so many different standards out there right now. Understanding what are the key business KPIs that you should be looking at. If you're looking at circular economy, what percentage of your production process is recycled? If you're looking at employee satisfaction, what are the KPIs you can capture around that? So making sure that you've got a good thematic approach, making sure that you understand what are the key metrics that you should be capturing, and making sure that you own your story. And a lot of the times we speak to corporates who say to us that they just had a conversation with an investor, and the investors walked in and said, can you walk me through your ESG process? And it's very hard unless you've got a connecting tissue to be able to say, these are the metrics we capture, and this is why. We're not going to be held beholden to a bunch of rating agencies who say, this is what we need to capture. That's not how we approach this. These are the metrics we capture. And I think there's a lot of value in that, particularly for smaller companies as well, because at that point you are avoiding greenwashing, because there's an alignment between capturing lots of metrics and saying, okay, look, we're doing a good job. But if you own your story and you say, actually, these are the metrics we're willing to capture because these are what's important to us, similar to what Ben was saying earlier about these are the stakeholders we value, this is how we weight it, and that's okay, because this is how we do business, and this is we're not going to touch every single point. So I think there's a lot of value in taking a thematic approach to governance and measures. And one thing I will say is I think a lot of companies feel that if they're not capturing metrics, they're falling under the radar. And that is absolutely not the case anymore. Perhaps it was 3 years ago. But today, what we're seeing is with the lowering cost of data capture, there are firms out there who are scraping the internet for KPIs around ESG measures. And those are then going into reports, and those are then being used by investors to make decisions. So you can either own your ESG reporting process, or somebody else will be doing it for you. It's certainly not if you don't do it, it's not being done scenario anymore. So I think one of the other areas that's particularly important around governance is being able to have the tools to be able to tie back the KPIs to outcomes. So I know both Lisa and Ben spoke about outcomes. So one of the things that we started to see more of is really good tools to link back ESG performance to either the top line or the bottom line. So for example, there are tools now that we use which show what 1 degree's change in climate would have as an impact on a particular company's revenues or bottom line. So we can start to sort of talk about ESG impact in very tangible ways. We can look at the war on talent or the war for talent. How can having a better ESG story improve A, your ability to retain and recruit high quality talent, but B, also ensure that you're not in a situation which we've seen this morning where a company with particularly poor employee satisfaction scores is about to IPO and has had investors turn around and say they will not invest because they are worried about the way in which they treat employees. So both the cost of capital and the revenue side can be tied back to ESG scores very effectively now, and those tools exist.
Yeah. Lisa, you look like you're ready to make a point there.
Yes, thank you. Now, I just wanted to comment on Bridge's sort of point there around owning your own ESG process. I think that's absolutely true. But there is also the risk, and we have seen this particularly in the US, where when that's the case and companies do it their own way, there can be a lack of sort of materiality, and it becomes more of a PR. This is the story we want to tell. But what ESG reporting is at the end of the day, and you can argue whether it's for your shareholders or broader stakeholders, but shareholders certainly will need ESG data to understand the risk profile of the company. So I definitely agree with that whole, take ownership of this sort of the process and really get to understand it very, very well. But it is not about PR. It is not about marketing. It's about risk management and what is really material for the company.
Yeah, I'd fully echo that. The only caveat and response I would say where there's an area of caution there, Lisa, is I'll give you one specific example. We spoke to a company last week they're in the semiconductor space. They said to us, we just had a call from one of our largest investors where they're either having to reduce down their position or close out the position completely. And the reason was because one of the ESG reporting or rating agencies had flagged up a governance risk at the company. And the governance risk was actually an issue where the chairman had to step into the CEO's role for a period of time to address a specific issue. And because of that, there was a flagged up risk, and therefore the position had to be potentially wound out. But what we found was through the communication between the corporate and the investor, there was dialogue had, there was an explanation, there was process discussed as to how that was going to be addressed. And there was an effective mechanism to be able to address that, as opposed to just saying, well, we've got a screener and you screened out. As a result, we have to close the position. So I think you're absolutely right. The data is important, but there is still opportunity for dialogue between investor and corporate.
Absolutely. Just very quickly on that, I totally agree on that. And I think the sort of external research providers' data needs to be taken with a pinch of salt, in the sense that they are often, for example, relative comparisons within a sector group. They may not be, absolute, the absolute reality for each company. It is really about relative comparisons, etc. So I completely hear your caveat there.
I think there are a couple of sort of key points in all of this. One is the individuality of a company and its business, and how, as it sounds, Porvair have done. It is far more sensible to take ownership on the deliverables that suit the business that you're in and you're in control of. And then you've got the whole question of passive capital. To use Bridges' example, where ratings providers are falling off trees like autumn leaves at the moment. So I think I read there are about 65 different global standards, and somewhere that some of them are going to be entirely inappropriate to the business. And that can lead to all sorts of errors and corporate problems we've seen pop up. Wirecard, Boohoo in its staffing in recent months, and those were both companies that were quite highly rated by some bodies before the working practice disclosures came about. So taking control seems to be an incredibly important point, as does communication. And we talked about engagement was the question, Lisa, but again, I'd throw it out to all of you that there must be a huge onus on a board and a company, a publicly listed company, to communicate, but B, benefits to come from it. And it's not just managing risk from ESG, but as all of us have alluded to, attracting capital, lowering your cost of capital, and positioning your business in the right way strategically for markets that are going to change by human practice changing, pandemics, climate change, all those are out there. So how do you all see the current levels of communication And is there hope out there for the poor investor trying to learn more?
But yeah, perhaps I could just talk from the small cap perspective, and I'd be interested in both well, everybody's views, because it's I think there's a peculiar situation where the companies, most small cap companies are completely under the radar of these 65 different standards that are set. They're utterly confused by which one should they latch onto, anything from the United Nations down to somewhere else. And what we're trying to do, through this research that I've mentioned, but also our guide is really just to say, look, just get started. And the beauty of being a small cap is that you have relatively few institutional investors who have relatively significant investments. So you can have relatively few conversations to really find out what those sort of investors, mainstream and also ESG centric investors, what they are looking for. And I think that's a really good starting point, is to have that conversation. So yes, it's sort of generally communication, it's dialogue, it's having specific conversations. And we certainly hear from small cap investors that 5 years ago, if people were 3 years ago, 2 years ago, people were talking about ESG, it was a slide in the deck, which was an appendix. It's now moved up to sort of third or fourth slide. Because, like Ben, it's moved from shareholder return to perhaps a fair return for shareholders in the context of ESG. So I think the small cap world, it is very much about finding real things to talk about, real evidence to produce, but in dialogue with the shareholders. And that way, it becomes a very direct conversation. I understand for larger companies that they probably have to go through more of a templated approach, but I think it's a huge opportunity for small caps to really grab this agenda and make sure they're delivering to their shareholders.
So I'd echo what Tim has just said. I mean, one of the things that we've seen a lot of recently is the collapsing of the sustainability report and the annual report into one document. So we started to see people, rather than producing an annual report adjacent to a sustainability report, have the metrics in one place. And I mean, not to talk our own book, but we run a quarterly survey of buy-side screeners. So we look at all the KPIs and buy-side are looking at to assess companies in specific sectors. And what we're able to do with that is give corporates a view as to what are the key KPIs that they should be looking at to A, have awareness of, and B, have reporting on. So I think one of the important areas here is to understand how rating agencies calculate their scores. And they typically do it on two things. One is transparency of disclosure, and secondly is performance of that metric. So just by having an element either within the annual report or by having an element within your sustainability report that says we are aware of our hazardous waste amount. We haven't reported it yet, but we are aware that we need to actually start capturing this, has value in itself for these rating agencies. And from a KPI perspective, as Lisa was saying earlier, you need a metric. So these metrics are being calculated. So making sure that you're aware of them within the report has incredible value. So we've seen that happening a lot more. And we've seen an opening up of corporates willing to understand what are the KPIs that investors are looking at when they screen against companies. And that data is starting to exist and starting to materialize for small caps and large caps.
Right. I'm seeing. Oh, sorry, Ben, carry on. Yeah.
Well, I was just going to say this. So the question was on communication, and Bridge was saying that people are putting their ESG report into their report and accounts. The Porvair report and accounts now runs to 146 pages, and I'd be very surprised if anybody reads all of it. So we've gone the other way for that specific reason, and to sort of really emphasize the point for people who perhaps are thinking about how to do this. What the ESG report really addresses is how is the company looking at, feeling about, and adjusting to changing circumstances. And when we all know when you go to an investor, they want to know what were your numbers and how are you adjusting to a changing circumstance. So in many respects, the ESG report is a very useful framework to talk about some wider issues than you ordinarily would about what happened in the last 6 or 12 months to this or that division. So it's useful as a communication tool. The other thing I would say about picking up some of the earlier points of the conversation is particularly for small caps, there is, I think, a perfectly legitimate sense as to why one should spend a lot of time and energy trying to measure a reduction in carbon emissions that is so minuscule in the general scheme of things. To give you some examples, Porvair produces 11,000 tons of CO2, roughly, emits that a year, and we're going to try and reduce that by a small amount. Now, that's of course important, but in the general scheme of things, one could question whether anybody should be interested in that. The much harder-nosed business aspect of this is in the S of ESG, and in our view, in our case, as I was saying earlier, in addressing issues around what your staff want, think, and feel. Now, 2020 was a perfect time to really focus on that because, of course, we were all having to work out how to continue to go to work in a COVID environment. I used to say, in a very poor joke, really, that a lot of people can work from home, but very few people can weld from home. And so it required quite significant changes in the way we ran our manufacturing operations, and therefore quite significant thought as to how the staff were feeling. Later in the year, of course, mental health and how people who were working from home and perhaps didn't want to were feeling, and those sorts of things. Now, these are sort of fundamental and important aspects that have a direct feed through to how your business performs. And so I think for us, that's been the big change in 12 months, that whilst the full panoply of ESG is fine, there are some aspects of it that have very near-term, hard-nosed business benefits. And perhaps one wasn't thinking about them quite as much in 2019 as one is in 2021.
Yeah, well, anecdotally, for those of us in the financial services industry, it is still an adjustment to read about Goldman Sachs being extremely worried about its junior employees working 98-hour weeks, which I don't think we'd have been reading a few years ago. I know you're itching to say something there, Lee, so I just sort of go back to talk about carbon, which you mentioned, Ben, because we're getting some questions in now, and one comes in relating to the panel's impression about how companies are seeing the importance of long-term strategy here. And the questioner uses the example of carbon offset debt, which for a business that is not well informed could be accumulating in the same way that we've seen pension deficits become a problem for listed businesses. Bridge, you're not nodding away there, or you think people are starting to think about things like carbon offset?
Yeah, I think so. I mean, just to put it in context, when Lisa mentioned CA 100 plus a little while ago, CA 100 plus, when they spoke to the FTSE 100, 90% of companies responded to them with details of their carbon emission plans, either through reducing directly or potentially using offsets or some other mechanism. So it's definitely something of focus for corporates right now. I think one of the challenges, though, and one of the things we're starting to see more of, is the gap opening up between a ESG rating and actual outcome performance. So, for example, we're starting to see situations where the CA 100 plus said that 50% of companies within the FTSE were not meeting targets in a way that would actually significantly align to goals and targets for the UN and the SDG perspective. But what we have seen, though, is a lot of those companies, 45%, have the top ranking from a ESG rating perspective. So carbon offsets are a very valuable component, and certainly they are incorporated into ratings mechanisms. But having an overarching target is something that is incredibly valuable. I know Ben mentioned earlier you don't have a target yet, but certainly that's one area that we've seen a lot of value and a lot of focus on having a target. How you achieve that target could be through direct reduction or through offsets.
No, we do have targets, Bridge. We have targets, and they go through to incentive schemes.
Yeah.
Now we've picked up another question that's that always intrigued me, which is whether investors should be consciously divesting from businesses that may be perceived to be doing harm at the moment, or is it in fact a case that if a mining major or a BP or a Shell address their activities or move away from natural oil and gas, as Ørsted have done, should an investor actually stay on board with an oil and gas major and use the general meeting as a situation where they can lobby? Or should they sell their shares, which will then be bought by someone who probably quite likes the returns that oil drilling is producing? How do you see that?
Impax, first of all, we are, fully focused on investing into companies that are already well aligned to a transition to a more sustainable economy. So this is not something that we are sort of grappling with much in our investments. But I would say that it is probably a combination of things. On the one hand, some level of divestment of the most exposed companies with stranded assets, or whose future earnings might be very severely affected by a carbon price, for example, is potentially very reasonable to divest or at least reduce that exposure. But then also, for the less exposed, but perhaps not today, perfectly aligned companies to be actively engaging is probably something that particularly together with other investors, perhaps through collaborative initiatives and engagements, can be quite effective. I think engagement to change a company's business model is hard, but I wouldn't say that that's something that investors and shareholders shouldn't try at all. But I'm quite conscious that it's a very big undertaking. So perhaps a slightly muddled answer, but I think it's a combination of those things, ideally.
Well, I think in the same way we've talked about individual companies adapting to what they do. Individuals make investment decisions, and some people are going to be more driven by ethical concerns. Some, as we all know, do want to see their investments perform, and they'll have to find the right balance in their own mind, or go to managers of money who are hopefully very transparent in how they are going to address that situation. We've had a couple of references to the pandemic and the changes that has made in terms of individual life, government responses. Do you think that this is going to be an accelerator that provides sustainable momentum for the ESG movement? Ben's already talked about the S becoming far more important, or realization of it in the past. I'm not asking for a medical view on whether another pandemic is likely or probable in the near future. But do you think the momentum that has been accelerated is going to continue?
Definitely. I mean, I think it was accelerating before the pandemic, and I think it's brought everything into focus. And certainly, the members of the QCA, the small caps, it's just on the agenda now. It's something which is seen as a given, and there's an absolute thirst for knowledge, ideas, approaches. We're seeing it. I mean, we see it at any event we're involved in. This one's a good example. There's a really healthy number of people who really want to know answers, and it's not just the people who are on this at the moment. They will take that back to the boardroom, and we'll be talking about it with 4 or 5 other people into the senior management. It's being inculcated the whole way through organisations, and I think that I do agree, with this. Do you invest in dirty companies or clean companies? But I think there's also a momentum thing where there's a huge investment opportunity to invest in dirty companies which are getting cleaner. And I think that that is something that we'll see a lot more of, where people recognise where the change is happening, and we'll see it. And this, everything around this subject, it's not a subject; it's a way of life now. You know, everything is accelerating for the good.
Yeah, no, I think well put. And just picking up another question here from the audience. Does the panel agree with the PRI that climate policy change is inevitable and will in fact lead over time to the erosion of value of real assets?
Yeah, yes is yes is the answer. I think whether it leads quickly to the erosion of real assets, I think obviously that depends on the asset. But should companies be considering? Sorry, I'm not being very articulate. Companies, in our view, should be assuming that these changes are coming and making sure that they know what to do when those changes arrive. I think that's the answer. Hoping that things don't happen or happen later than people are expecting probably isn't a sensible corporate strategy in our view.
Right, and we've a little bit of time left. We're trying to finish within the allotted hour, so maybe we can talk a little bit about the future and all of your individual views, hopefully with optimism. But I think particularly in terms of regulation, measurements, you know, qualitative analysis, is the environment going to become better, more informed, with positive implications for not just investors but companies who are trying to follow the best path? Tim, do you want to kick off on that one?
It's a huge question, isn't it? I mean, I think I'll stick to the S of ESG in terms of answering it. And I think, you know, we've heard of companies where, you know, they've said to us, look, you know, this ESG thing, you know, we can't avoid it anymore because of our workforce. You know, we've got a young workforce who are determining, you know, where they work, how they work, by virtue of what the company does, what the purpose of that company is. And if they can believe it, then they will stay there. If they don't believe it, if they think management are just a bunch of dinosaurs who, you know, really, you know, are pretending, then they will vote with their feet. So I think that, again, as I say, I mean, I think it is now a way of life. And I think on the social side of things, that drives the E. The G is waking up as well. And I think it's, you know, we've always said that our corporate governance code is not about policing. It's about enabling companies to grow with through the right structures and behaviors. And I think that will be evidenced in whatever comes out with ESG guides. You know, it's about enabling companies and their investors to communicate with one another on real things with real evidence. And you know, for me, yeah, 4 or 5 years ago, I'll put my hand up and say, if somebody said ESG, I rolled my eyes and thought, oh, you know, sort of stuff that doesn't really matter. Since I invested in the Impax Environment Trust, I've changed my mind. But, you know, I have changed my mind. It's a complete, you know, sea change for me. And that's over the last 3 or 4 years. And just, we want to play our part in really driving this forward.
Yeah. No, well said. And again, as information comes out, I've seen studies are starting to build that companies who get their E and their S right are automatically scoring highly in terms of the G as well, which actually makes quite a lot of sense when you think about it. Bridge, how, apart from being very busy in your role, how do you see the future?
I think we're really, really positive. And I think we're positive for 3 reasons. Firstly, this debate around ESG has increased the dialogue between corporates and investors. And that's been incredibly valuable, incredibly important. And whether it be asset owners as well have come to the table. So we've actually got this trifecta of conversation happening between asset owners, asset managers, and corporates. And quite frankly, more dialogue is better. And so we've seen some really, really positive conversations happening between those 3 groups. which is fantastic. The second reason I'm incredibly positive is because while I do sympathize with the information overload and data issue, we are starting to see a significant body of long-term time series data being captured, and that data being used to understand which KPIs link back to corporate performance. And that has been incredibly valuable. There's been a ton of work that's been done recently on large, long series data to understand which KPIs link back. And that's incredibly powerful and starting to have real material impact in both corporate decision-making and investor decision-making. And the third reason I'm happy or positive is regulation, which I never thought I'd hear myself say. But hey, I think the challenges we've seen with SFDR and we've seen what's happening in the US, the regulation is somewhat vague. And I mean, I think the SFDR report now goes to about 600 pages. So it's certainly long. And Ben made the point about long annual reports earlier. This is even longer than that. So I think what that's going to require is an ability for both corporates and investors to find their own road in this and understand how they're actually going to navigate the regulation effectively, which I think is going to be a positive, because I think all constituents are very, very focused on understanding, as Tim said, that ESG is not just a tick in the box or something that is a necessary evil. It is a way of life. And if it's a way of life now, we are now going to have to find our way through this road, as opposed to expecting a regulator to give us a template to fix this. So I'm incredibly positive and incredibly optimistic.
Yeah, good to hear. And let's not forget that in the background, the advances in AI and big data are making the accumulation and the analysis of all this data so much easier and quicker as well. Ben, any optimism on your side, I hope?
Always optimistic. I think in this regard, I mentioned earlier, we have two principal measures of success: progress in ESG metrics and consistent earnings growth. And we haven't really touched on that in the last hour for obvious reasons. But of course, it is of tremendous importance for shareholders in particular. But I think the optimism stems from the fact that with a bit of thought and possibly some adjustment, one can get into a virtual circle of both of those objectives getting better, and one reinforcing and supporting the other. And certainly we are now finding that, and I think we can get better at it. And I would think most businesses would find themselves in a similar position.
Yeah, good. And Lisa, you weren't there when Impax was started. I have distant memories of it, but the rate of progress, 25 years sounds a long time, but the sustainable benefits to the planet are so materially different from then. I'm sure you see that continuing.
Absolutely. It has been, even for my 10 years, a tremendous journey from the first sort of 5 years, pretty much trying to almost convince the marketplace that investing in environmental solutions and sustainable companies is a good way of investing from a performance perspective, but to one of the marketplace really starting to understand it and growing so tremendously, as you say, Andy. But I do think that this way of investing is the sort of future of investing. I think we need to, as investors, develop much broader skills, not just financials and accounting, etc., but understand science, understand social aspects, etc., because that's actually what companies are about. They are affected by all of these things. It's not just numbers. And I think that's where the realization is coming, and that's why finance is changing quite quickly. So I'm extremely excited about that. And I really would emphasize what Tim was saying also about purpose. I think the future of work is going to be, that whole aspect of purpose is going to be absolutely critical for those young people coming into workplaces. They have a very different starting point and mindset than we had when we started our working careers, etc. On policy, just very briefly, I do think that, completely echo there, that I think it's going to change things. There's going to be much more requirements of evidence and reporting, transparency, and sort of measuring actual impact of your investments, which is complicated, but that just has to happen. And that also has to happen from the standpoint that what we report has to be credible. We cannot have this sort of greenwashing fears undermine this really important move of investing much more sustainably. But I would say, though, that I think at some stage it needs to there needs to be a bit of reflection of what is the right amount of reporting, because to some extent we sometimes do feel that today we are doing almost only reporting, while we should be doing, idea generation of new great environmental solutions or engaging with our companies. So there is a balance to be struck. There is a bit of a, train wreck, I guess, of reporting requirements at the moment. But it is, of course, very, very, very important as well. So very positive outlook, I would conclude by saying.
Good, a suitable note on which to finish. So I would like to thank the audience for your attention. We will make the recording of this event available very shortly if you want to look through it again. I'd commend the QCA and Henry Business report that is available from the QCA website. And last but certainly not least, I would like to thank all of our panelists for very insightful and very interesting contributions. Thank you all.